Stock markets hitting record highs after we got interest rate cuts last week in Canada and the United States. But there is another side to that lower rate story, the risk that dovish policy could fuel a bubble. Let's get more from Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks very much indeed for joining us. So that is true, isn't it? People may start thinking, well, there's no alternative but to buy stocks if rates are falling like this.
Yeah, if you have money to buy stocks, that's a big question. Debasement of the U.S. dollar and its purchasing power is hurting Main Street. And you have a situation where you have only 10% of U.S. consumers driving 50% of consumer spending. And those 10% are those who own assets, like stocks and houses. So they're doing very well. In the meantime, you have 72% of CPI components growing at faster than the Fed's 2% inflation target. And then I read something this morning that Fannie Mae said that home prices in the U.S. need to fall 40% or incomes need to rise 60% just to return housing prices to where they were in 2019. So you tell me how cutting interest rates is going to solve that problem.
Yeah, you're right. That income inequality, pretty incredible, especially south of the border, but also in Canada as well. One interesting observation you have is that long-term bond yields have barely changed, even though rates are coming down. And that indicates fears of government debts getting out of control.
Yeah, and also gold going over 3,700 is telling you that it's a clear red flag that the bond markets want you to cut deficits, not cut rates. Cutting rates to support further deficit spending levels like we're in a financial crisis when at the same time we have stocks at all-time highs, housing prices doing quite well in the U.S., and Main Street suffering. Cutting interest rates is just going to further inflate assets and widen the inequality, and that's going to create political instability, and we're seeing that in the U.S. For example, and globally. So there's a pushback that you have to get your fiscal deficit spending under control, and in Canada, we're going to see some pretty big numbers coming out here. There is the excuse of tariffs, or there is this or that, but long-term yield bond markets are saying, nah, we're not supporting that.
It's interesting, your observation that monetary policy, it's meant to lift all boats. It's a pretty crude instrument, but you reckon, sure, it may be helping the wealthy, but it's not helping ordinary people. And also, I'm curious, if Canadian companies aren't investing, what use are lower interest rates? They're not borrowing for CapEx anyway.
Yeah, they're not redeploying it. So the ones that are benefiting from it are, like for example, in the tech space in the U.S., where they have benefited tremendously from using that capital to do a lot of massive share buybacks, and now they're using it for AI expansion. But how much of that AI expansion and the data center spending is going to trickle its way through into job growth and the person on Main Street, and it may not, and so. And in Canada, if they're not going to redeploy that capital because of policies here that prohibit that, like Bill C-69, for example, and others, then what's the benefit to the person that doesn't have a government pension plan, that doesn't have a home that they bought at 10 cents in a dollar 20, 30 years ago? What's that going to do to the young person that's facing 14, 15% unemployment in Canada?
You have some stock ideas for us. Just quickly tell us, what are structured notes? Remind us, Martin, please, and tell us why you think they offer promise for investors.
Well, what we've done is we've replaced our fixed income component, which has been a terrible investment over the last 5 years for investors, and replace it with structured notes. A structured note is basically a vehicle that wraps in a whole bunch of derivatives around an index and is packaged up like a bond because it's backstopped by the credit rating of a bank that's issued. So Trudeau did some tax changes, and it is taxed as income. So from that perspective, it'd be similar to a bond. But there's different types of notes that have 100% principal protection, backstopped by the banks, and Canadian banks. And then some that have a little bit less downside protection, and it offers yields that are pretty attractive from 6% all the way up to low double digits, depending on the downside protection you want. So that's been a really good trade. For example, my parents, they're baby boomers. They've monetized, sold all their real estate, put them in structured notes. They're renting. They love the lack of worry about everything and packaging up and going traveling and using the notes to pay for everything and living with some peace of mind there. So that's why we like notes.
And they're enjoying renting. It's one of my fantasies, just own nothing and just have somebody else fix their drains.
Yeah, I got to get my kids out of the house before I do the same. So at this pace, I'm going to be a homeowner for a long period of time.
You have an ETF idea for us, the Global X Equal Weight Canadian Telecom ETF, RING is the symbol.
Yeah, so you want to look at, as you mentioned, what's falling rates going to do and who's it going to help? Well, those who do have leverage already deployed, like the telecom space, they're going to benefit from falling rates. Their cost of capital will be coming down. That will support their dividends. That particular ETF, I like it because you can just own all three. You don't have to try and pick which one's better, although we do have favorites among the three. But simplistically, if you want to just own that space, that's an ETF that we like. Pays a 5.3 to 5.5% dividend, half decent if the telecom can manage to correct themselves. A lot of immigration in Canada, and I don't know if you noticed, but everyone has a nice new iPhone or cell phone, so they're going to continue to support consumer spending on that within Canada. People are more willing to make their cell phone payments these days than car payments, so getting a 5.5% dividend to help offset the cost of your cell phone bill will certainly help.
Thanks very much, Martin. Always great hearing from you. Martin Pelletier, a Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel.